Hi there, and welcome to Coffee Chats with Klaas. My name's Kyle Kite, and today we're joined by Josh Sterling, who is a chartered financial analyst and a portfolio manager here at Klaas. And today we're going to talk with Josh about asset allocation and why it's an important consideration to all investors. So thanks for joining us, Josh. Can you talk to us about what asset allocation means for a new investor?
Thanks, Kyle. Yeah, from a simplified viewpoint, an asset allocation is the breakdown of your investment strategy. This is typically the amount of money you invest into stocks, bonds, and cash, into which you put more of your money towards. This will have a big impact on your investment experience and the types of returns you should expect.
So speaking of the investment experience, what should an investor be ready for?
Good question. It is difficult to predict, but we can look for a little bit of guidance. Stocks, historically, have outpaced bond returns when you look at long periods of time. Although having a higher return doesn't come for free. Stocks tend to move around significantly compared to bonds. In rough times, it is critical to be able to stomach the pullback in the market if you have a significant amount in stocks. Bonds, however, tend to be a bit more stable and can be a haven during turbulent stock markets. Bonds are a promise to pay back what was borrowed. There are many types of bonds, like corporate bonds, home loans, and U.S. government treasuries. These tend to have stability of principal while you earn coupon payments along the way. Bonds traditionally earn a lower return than the stock market, but may be wanted by those who don't want to weather the storm. However, it's important to note that during times of inflation and in increasing interest rate environments, bonds can also be affected in a negative way.
Okay, so given that these are two different investment types, how do you use these investments when building out an asset allocation?
In portfolios, we split the proceeds and put some into stocks and some into bonds. This creates diversification by using different investment types. The intention here is when one zigs, the other zags, and it can help smooth out the overall investment process.
Great. In my experience, as someone who's preparing to invest, picking the right asset allocation can be an important but tough step. So what are some of the ways they should look to build out their asset allocation?
To your point, picking the right allocation can be challenging, but we should still look at it as an important step to investing. It's important to be in the right mindset when making this choice, being sure not to gloss over certain considerations. I like to compare this experience to buying a home, actually. When looking to purchase your next home, the first consideration is not likely to be centered around whether you want a house with a brown roof or a gray roof. You typically ask yourself more critical questions like, how much are property taxes? How long do we plan on living here? Is the house close to our grandkids? Or how much living space do we actually want? Now, luckily, picking an appropriate asset allocation isn't nearly as time-consuming or difficult.
I like the framing of buying a house, but why is this similar to picking your asset allocation?
For most, the reason for investing is centered around helping achieve our long-term goals. Too often, it can be easy to let temporary market turbulence either stop us from investing or drive the decision of what allocation might be best. Because of this, it's better to consider factors that are within your control and will align with your long-term goals, just like you would when you're buying a home.
Great. So what are some questions that would help frame the asset allocation decision for an investor?
Let's talk through some of the big questions that should be answered before you decide on investments. A question like, what is the money going to be used for? Will help you determine the purpose of investing, like retirement, vacations, or schooling. It'll also help you consider if you're looking to pass on your wealth to families or charities. Then a question like, how long until I need to use the money? Will help you determine how long you have to invest. When identifying your time frame, it's important to consider beyond the event. For example, you might retire in 5 years, but the average retiree is going to need money from their investments for more than 20 years. The last big question to ask is around the risk you're willing to take. Consider times like the Great Recession or COVID. Think how comfortable you are experiencing the full swings of the market during those times. If seeing your portfolio drop by a significant amount worries you, it might be best to focus on more conservative allocations. Ultimately, a culmination of these factors and more should help narrow the focus on how much you should invest into stocks, bonds, and cash. To use a basic guidance, the longer you have to invest and the more comfortable you are with dips in the market, the more you should put towards stocks. Some people may even have the majority of their portfolios in stocks, especially if they're in their 40s or 50s and still have plenty of time to retirement. This might be daunting at first, but our experienced advisors are equipped to work with you to make this decision as easy as possible.
That's great, having some self-reflection to help guide the decision-making process. Well, once an investor is able to determine the right asset allocation for them, how should they maintain it?
An investor should review life circumstances and plans on a regular basis. It's important to check in and ensure that your long-term goals haven't changed. If you suddenly decided to retire 5 years earlier, you might need to adjust your allocation. In addition, over long periods of time, your portfolio may naturally drift as stocks could have higher returns. You may need to rebalance your account back to target.
With so much going on, you probably need to monitor your accounts frequently, correct?
You should always have access and some oversight to your investments. However, it's also important not to overmanage your investments. It's critical to stick with your goals and avoid tweaking, even when markets might not be in your favor.
Thanks, Josh, for talking us through the steps in designing an asset allocation. Seems that everyone is different and needs to consider their own goals and risk they're willing to take. If you have questions or need help building out your investment strategy, please reach out to one of our advisors at Klaas Financial. They'd be happy to help you in your retirement planning needs. And thank you for joining us for Coffee Chats with Klaas.